Investing in the stock market can feel like navigating a ship through a dense fog. There are countless factors to consider, and uncertainty clouds our judgment. But there's a tool that can help us see through the haze: historical comparison. By looking at a company's past performance, we gain valuable insights into its future potential. This is especially true when it comes to understanding a company's price-to-earnings ratio, or PE ratio. Imagine you're about to buy a house. Would you simply accept the asking price without comparing it to similar houses in the neighborhood? Of course not. You'd want to know if you're getting a fair deal. The same logic applies to stocks. By comparing a company's current PE ratio to its historical average, we can determine if the market is valuing it fairly. Historical comparison acts as a compass, guiding us through the volatile world of stock market investing. It allows us to identify trends, spot anomalies, and make more informed decisions. While the past doesn't guarantee the future, it provides a valuable framework for understanding where a company has been and where it might be headed. The PE ratio is a fundamental metric used to evaluate a company's stock price relative to its earnings. In essence, it tells us how much investors are willing to pay for each dollar of earnings generated by the company. Calculating the PE ratio is straightforward. Divide the current market price per share by the company's earnings per share, or EPS. For example, if a company's stock is trading at $50 per share and its EPS is $2, its PE ratio would be 25. This means that investors are currently willing to pay $25 for every $1 of earnings. But the PE ratio is not a static number. It fluctuates based on a variety of factors, including company performance, market sentiment, and economic conditions. To gain a deeper understanding of a company's valuation, it's crucial to analyze its PE ratio over time. By charting the PE ratio over several years, we can identify trends and patterns. This historical perspective provides valuable context for interpreting the current PE ratio and assessing whether a stock is potentially overvalued or undervalued. Remember, the PE ratio is just one piece of the puzzle when it comes to stock valuation. However, it's a powerful tool that can help us make more informed investment decisions. Now that we understand what the PE ratio is and how to calculate it, let's explore how to determine if a stock is cheap or expensive based on this metric. A common misconception is that a low PE ratio automatically signifies a cheap stock, while a high PE ratio indicates an expensive one. However, it's not quite that simple. The PE ratio must be considered in relation to a company's historical average, its industry peers, and its future growth prospects. A stock with a PE ratio lower than its historical average or its industry peers might be considered undervalued or cheap. This suggests that the market may be underestimating the company's earnings potential. Conversely, a stock with a PE ratio higher than its historical average or its industry peers might be considered overvalued or expensive. This could indicate that the market is overly optimistic about the company's future prospects. However, a high PE ratio could also be justified if the company is experiencing rapid earnings growth or operates in a high-growth industry. Investors often use the PE ratio as a starting point for further research. If a company's PE ratio appears out of line with its historical norms or its industry peers, it warrants a closer look to understand the factors driving the discrepancy. Section 4. Mean Reversion, the market's invisible hand. Mean reversion is a powerful force in the financial markets. It suggests that over time, stock prices and valuation multiples like the price-to-earnings ratio tend to revert to their historical averages. This concept is rooted in the idea that market sentiment and investor behavior often swing between extremes of optimism and pessimism. When investors become overly enthusiastic about a company's prospects, they may bid up its stock price, driving its price-to-earnings ratio above its historical average. Conversely, when pessimism prevails, investors may sell off the stock, causing its price-to-earnings ratio to fall below its historical average. Mean reversion implies that these deviations from the historical average are often temporary. Eventually, the market tends to correct itself, pulling the price-to-earnings ratio back towards its mean. This doesn't mean that every stock will always trade at its historical average price-to-earnings ratio. However, it suggests that extreme valuations, both high and low, are often unsustainable in the long run. Understanding mean reversion is crucial for investors because it highlights the importance of taking a long-term perspective. While short-term market fluctuations can be driven by sentiment and speculation, over the long term, fundamentals matter. Section 5. Profits, the engine of stock price growth. At its core, the stock market is a mechanism for companies to raise capital and for investors to participate in their growth. When you buy a share of stock, you're essentially buying a small ownership stake in that company. As a shareholder, your investment's success hinges on the company's ability to generate profits and increase its value over time. Profits are the lifeblood of any business. They fuel innovation, expansion, and ultimately shareholder returns. When a company consistently generates strong profits, it has more resources to invest in research and development, acquire new assets, expand into new markets, and reward shareholders through dividends and share buybacks. This, in turn, can lead to higher stock prices. Investors are naturally drawn to companies that can demonstrate consistent profitability and strong earnings growth. These companies are seen as more likely to generate attractive returns for their shareholders, making their stock more desirable. Therefore, understanding a company's profitability is essential when evaluating its stock. Analyzing key financial metrics such as earnings per share, net income, and operating margins can provide valuable insights into its financial health and its ability to generate profits. Section 6. Price to earnings extremes when ratios defy history. While mean reversion suggests that price to earnings ratios tend to gravitate towards their historical averages, there are periods when they can deviate significantly from these norms. These deviations often coincide with periods of extreme market sentiment, either exuberance or fear, which can drive valuations to unsustainable levels. During periods of irrational exuberance, investors may become enamored with certain companies or sectors, bidding up their stock prices to levels that far exceed their fundamental value. This can lead to extraordinarily high price-to-earnings ratios, as investors are willing to pay a premium for a piece of the perceived next big thing. Conversely, during periods of market panic or fear, investors may indiscriminately sell off stocks, even those of fundamentally sound companies. This can result in extremely low price-to-earnings ratios as the market undervalues even companies with solid earnings and growth prospects. These periods of price-to-earnings extremes can present both opportunities and risks for investors. For the astute investor who can remain objective amidst the market frenzy, these deviations from historical norms can create attractive buying or selling opportunities. However, it's important to remember that extreme valuations are often unsustainable in the long run. Eventually, market sentiment tends to shift and price-to-earnings ratios revert towards their historical